cash was king in 2024, outperforming even high-quality fixed income, while recession fears kept investors on edge. As we now enter 2025, the Fed's rate-cutting cycle is shifting the landscape. Could the great cash rotation be the biggest fixed income story of 2025? We will break it all down for you right here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm your host, Dan Cassidy. We are joined today by Head of Taxable Fixed Income Strategy for the Americas with the UBS Chief Investment Office, Leslie Falconio, joining us today to update us on fixed income markets. With that, Leslie, Happy New Year to you. Thank you for joining us today and for spending some time with our viewers. It's great to be with you to kick off another year.
Thank you, Dan.
So thinking back to where we were this time last year, Leslie, we did enter 2024 with a cautious outlook. I do recall at the time there were fears of a recession dominating headlines. However, 2024 turned out to be a great year for risk assets. So to start, Leslie, can you remind us of the drivers behind performance last year? And should we now be entering 2025 with more caution?
Well, I mean, Dan, you're absolutely right. When you think about how we entered into 2024, the market was very skeptical of the ability of the Fed to actually maneuver a soft landing. And at that point in time, they were pricing in, 160, 170 basis points of cuts because they really felt the economy was slow and they were losing a lot of faith in the Fed, given the fact that the Fed had moved so aggressively in terms of hiking and kept it there for a fairly long period of time. But as the year progressed, even though we had these bumps in the road of occasional, soft economic data, some headwinds in terms of employment reports, I mean, overall, I think 2024 was a year where the investors and I think the consumers both, recognized that soft landing was more than likely the outcome that we would have. I mean, the consumer has been resilient, household balance sheets have been resilient, corporate balance sheets have been resilient, and as a result of this, what we saw was, number one, the capital markets, which remained open and because of loose financial conditions, which was really a key driver to some of these risk assets. And also, we had some investors come off those sidelines and start to invest in, yield and risk assets within fixed income to gain some of that incremental, total return via compounding income. Now, as we sort of enter 2025, the recession rhetoric is by the wayside now, but now we have to really look going forward and say, where's the value here? Because, a lot of these, potential Trump policies are, been priced in. We call them the Trump bump. So a lot of these expectations of, tighter spreads, higher growth have been priced into the marketplace. And really what we're grappling with now as we enter the new year is how not only these policies will play out, but as we recently just saw from the December Fed meeting, how will the Fed play out? So what will be the sort of like the determinant of the Fed, and how does the Fed, now manage this forward guidance, given the fact that we have a much more resilient economy that they anticipated, that these higher rates haven't been a large headwind to consumer to really alter demand, mostly overall in the U.S. economy. So what we have now is a start to the year where it's just the opposite of 2024 in the sense that the market's not what we would call dovish in terms of future Fed policy. It's actually hawkish. And why we say that is they're only pricing in about 30 basis points, 35 basis points of cuts throughout 2025. We in CIO are only expecting 2 cuts in 2025, 125 basis point in June, 125 basis point in September. So you've seen a really big turnaround from the start of 2024. And now it's not just about the fact that, people believe that there's going to be a recession or a hard landing. Everyone's looking at this soft landing. But really the concern is there a reacceleration of what we call negative fundamentals, which would be such things as inflation, which would be a headwind to total return, not just the equity market, but also the fixed income market, which are now much fully valued today than they were back a year ago.
So, Leslie, it's interesting you mentioned that Trump bump. In the wake of that, we have seen fixed income spreads compress, yet cash did outperform quality fixed income in 2024. What are your thoughts on cash as we're now entering into 2025?
Well, it's interesting because it's important to remember that we entered 2024 as we had been the past years, the 2 years prior, with an inverted yield curve, meaning that the short end rates were higher than longer end rates. So the ability for an investor to lock in higher yields, given that inversion of the yield curve, really just something that kept compounding. But it's important to remember two things. One is that even though interest rates rose in 2024, the short end, the real short end, meaning like things like the 1, 3 month, 6 month T-bill actually went down. The 2 year treasury stayed unchanged, but that back end, that 5 year and out, actually rose anywhere from 40 to 70 basis points. Even that with that rise in yield, which obviously causes prices to come down, you still had a positive total return in fixed income because of spreads compressing and compounding income. The only really place that you saw, a negative total return was way far in that back end, that 20 plus year, because that was a spot where when we look at how sort of wrong, investors were heading into 24 thinking the consumer would fall, that recession would enter, and, not knowing how the election would play out, it's done a complete, reversal in the sense that the consumer's strong. We have a Republican sweep, so that back end has really moved up quite a bit. Now, when we think about the cash, in today's market, we're not inverted any longer, right? The yield curve has normalized. It's upward sloping. So therefore, that lock-in that an investor once had in cash a year ago versus today is about 100 basis points lower. And in fact, we have things such as IG corporates, say at a 530 versus, a cash in the 490s. So IG is actually a higher yield today than the cash market. And it hasn't been like that necessarily in years past because of that inversion. So when you think about they have a lower lock in today, and also I do want to mention the fact that we still do, and we believe that they are still going to cut in 2025. It might not be as much as we originally anticipated, but we do believe that a cut is still in hand, which will just be, a another measure of lowering that cash yield over the next 6 to 8 months.
Leslie, something else I want to bring up, 30-year bond yields, they have been on the rise, has caught the attention of investors. Any cause for concern here? What's driving this move?
Whether you think interest rates are going up or whether you think interest rates are going down, we still believe that the yield curve is going to steepen. In those scenarios, that back end of the yield curve really starts to underperform. Now, one of the reasons why it's really been sort of magnified as of late is one, because, we have inflation that, although not really moving higher, has that delta, that change hasn't been going lower, right? So it's been kind of stagnant, and we're obviously not near that Fed target. That's the first thing. The second thing is that with potential pro-growth policies, in the months ahead, and with the potential inflation staying fairly stagnant, if you want to lock up your money for a long period of time, you need to be compensated for that. And when that we look at that compensation in terms of what we call term premium, and that back end part has really been taking the brunt of that in terms of having to expect to be compensated for going so far out the curve. The second thing is that because inflation has been a driver, or concern over inflation has been a driver of interest rates moving up. If the equity market has a positive total return, you'd think that the treasury market would have a negative total return and vice versa. But what's happening now, particularly in December, because it was inflation related, these returns are turning positive. And because of that, those that own that back end start to get a little bit more cautious. Now, when we think about going forward, and we've talked about this before, our most of our positioning has been in the 5 year area of the yield curve. We would look to extend further out to 10-year, or a little bit more. Once the 10-year Treasury at a minimum reaches that 2024 high of 475, and we're often asked, could we see that 501 Treasury yield that we saw in October 2023? Of course we could see it, right? We don't know what kind of policies are going to be, put through. We don't know the timing. We don't know the duration, and because of that, those unknowns can create a lot of knee-jerk reactions. So we could see a 5% again. We just don't think it's going to be sustained. So that's one of the reasons why we have that back end moving up. Part of its growth, but mostly has to do with inflation going up and investors now wanting more compensation for locking their money up for a longer period of time.
So, against that backdrop, Leslie, before we close out, I would like to spend a moment on positioning considerations as well when it comes to risks that investors should be mindful of. Can you cite what those are? And how is CIO recommending that fixed income investors be positioned as we're heading into the early days of 2025?
Well, there's a couple of things. One, and listen, we're looking for this. We have been for a long time looking for the soft landing, right? So we haven't been in this. We're going to have a recession. We're going to see a large slowdown, below trend kind of growth camp. But everyone's sort of like on the same side now. So when everyone's on the same side, we are a little bit cautious. And what I mean by that is, risk assets in fixed income are really fully valued. That doesn't mean that they're going to widen out, right? You'd really have to see, in terms of risk assets, materially widen out. You really would have to see inflation reaccelerate, right? That would be the tailwind to widening spreads. If it's growth related, great. Then the fixed income market will be able to handle that. If it's growth related and yields move up, it's not going to be a problem. But if yields are moving up because of reacceleration of inflation, that becomes a concern, particularly when you are so fully valued. So one of the things that we've done in our fixed income side is that, given what you're offered in higher quality like investment grade corporates, agency mortgage-backed securities, that, on the agency MBS side and on the municipal side, that didn't bode as well in 2024 as corporate credit did. Those sectors on a relative value basis, we think, are not only going to be good in terms of compounding income, but they're also relatively cheap. And those assets, like investment grade corporates, that we wouldn't label on the cheap side of the spectrum because spreads reached the levels that we hadn't seen since 2007, we think offers still that high quality and that compounding income, which is going to be a really big tailwind to total return. Now, we've stayed around that 5-year area of the yield curve, but one of the things that we recently did, Dan, is that because of this uncertainty regarding policy and implementation, and the fact that, the Fed has really shifted its sort of outlook in terms of what that terminal rate might actually be, we added on the senior loan side, right, in the beginning of December. We added on senior loans because of that high for longer, because I get a 7-8% income that I can compound, and because we still believe that, fundamentals are strong. Real wages are strong. The consumer's still strong. And although we do anticipate the labor market to soften up, we don't think it's going to collapse. So we're still looking for this soft landing, if you will. We still look for an above trend economic growth. We're not looking a lot in terms of spread compression within fixed income, but we are expecting locking in this yield not only is much higher than cash right now, but to compound that and have things steady in terms of spread basis will generate a good total return for 2025.
Well, Leslie, do appreciate the actionable positioning guidance and the insights into fixed income markets as we're embarking on a new year. A great catching up with you as always, and do look forward to continuing the fixed income conversation throughout the year.
Thank you, Dan.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, including LinkedIn, Facebook, Instagram, and Twitter, and check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with a UBS financial advisor. Until next time, I'm Dan Cassidy. Have a great day, and remember to keep your eyes on what's trending.